In the United States, personal finance has long been framed as a matter of discipline. Spend wisely, save consistently, and the future will take care of itself. For decades, the 50/30/20 rule offered a sense of order. Half of income for needs, 30% for wants, and 20% for savings. It was simple, reassuring, and deeply American in its promise of balance. But in 2025, that balance feels increasingly fragile. Interest rates sit at levels not seen in a generation. Rents reset faster than wages. Credit card APRs quietly cross thresholds that once signaled distress. The rule remains printed in textbooks and budgeting apps, yet daily life tells a more complicated story. For millions of households, the question is no longer how to optimize discretionary spending, but whether the category still exists at all. This documentary begins at that point of tension, where a trusted financial rule meets an economy shaped by inflation persistence, tighter liquidity, and a growing gap between statistical stability and lived reality. The first warning signs appeared quietly. They did not arrive as a market crash or a sudden spike in unemployment, but as distortions in everyday ratios. Housing costs consume not 30% of income, but 40, sometimes 50. Grocery bills adjusted upward month after month, even as headline inflation cooled. Real wages lagged behind nominal gains, eroded by healthcare premiums and insurance deductibles. At the macro level, the signals were visible: an inverted yield curve, rising delinquency rates on auto loans, and shrinking excess savings left over from pandemic stimulus. Liquidity tightened as banks raised lending standards, reflecting higher funding costs and regulatory pressure. None of this signaled immediate collapse. But together, these indicators suggested stress moving through the system, slowly and unevenly. The 50/30/20 rule was not breaking because people forgot how to budget. It was breaking because the inputs, prices, credit conditions, and income stability had fundamentally shifted. An economic shock does not begin with collapse. It begins with transmission. Higher policy rates move first through bond markets, then into mortgages, auto loans, and revolving credit. Adjustable rate debt resets. Refinancing windows close. Households that once used cheap credit to smooth expenses now face compounding interest. In 2025, average credit card APRs exceed 20%, effectively taxing short-term survival. Real estate, long a stabilizing asset for the middle class, becomes a source of rigidity. Homeowners stay put, renters absorb the adjustment. As liquidity drains, consumption slows, not because people choose restraint, but because cash flow dictates it. Under these conditions, allocating 20% to savings becomes aspirational rather than practical. The rule assumes flexibility. The shock removes it. This pattern is not unique to the United States. History offers clear parallels. During the Asian financial crisis of 1997, households in IMF-assisted economies followed prudent habits, yet were overwhelmed by currency collapses and dollar-denominated debt. In Argentina, repeated cycles of inflation and devaluation turned savings into a liability. Greece's austerity era showed how fiscal adjustment can hollow out middle-income security. Turkey's experience revealed how loose credit followed by abrupt tightening distorts personal finance. Venezuela represents the extreme, where money itself ceases to function as a store of value. In each case, traditional budgeting frameworks failed, not because they were wrong, but because macro instability overpowered micro-discipline. Compared to those countries, the U.S. retains crucial advantages. The dollar remains the world's reserve currency. Treasury markets are deep and liquid. Credit default swap spread signals stress but not systemic panic. Yet these strengths can mask vulnerability. Exchange rate stability does not lower rent. Sovereign credibility does not cap childcare costs. In 2025, the American economy exhibits a familiar divergence. Asset holders benefit from higher yields, while wage earners face compressed margins. The 50/30/20 rule was designed for an era of steady growth and declining interest rates. It struggles in an environment defined by volatility and repricing. Looking forward, the analytical outlook is mixed. Inflation has slowed, but remains sensitive to energy prices and global supply chains. Labor markets are cooling, not collapsing. Productivity gains from technology promise long-term relief, but offer little immediate comfort. Real estate may stabilize, yet affordability remains historically low. The future is not one of imminent crisis, but prolonged adjustment. In such periods, rules of thumb lose precision. Personal finance becomes less about balance and more about resilience, maintaining optionality in an uncertain landscape. The response from the U.S. government and the Federal Reserve reflects these constraints. The Fed's mandate is price stability and maximum employment, not household budgeting. Rate cuts are cautious, conditional on data. Balance sheet policy remains restrictive. Fiscal policy, shaped by political gridlock and rising debt service costs, offers targeted relief rather than broad transformation. These tools can soften extremes, but they cannot restore the assumptions underlying the 50/30/20 rule. Policy manages aggregates. Households live in specifics. For individuals, survival strategies have evolved. Needs now require negotiation, downsizing housing, relocating, or sharing costs across generations. Wants shrink not by choice but by necessity. Savings, when possible, become defensive. Emergency funds, liquidity buffers, and inflation-aware assets. The emphasis shifts from percentages to priorities. Cash flow replaces categorization. Flexibility replaces symmetry. This is not financial failure. It is adaptation. Everyday life reflects this shift. A family delays medical care due to deductibles. A graduate postpones homeownership indefinitely. Side income becomes structural, not supplemental. These are not isolated stories. They are statistical patterns, visible in labor participation, consumer sentiment, and credit usage. The economy functions, but it functions differently than the rules once assumed. So does the 50/30/20 rule still work in America in 2025? As a teaching tool, yes. As a rigid framework, no. It describes capacity, not comfort. It assumes stability where volatility now dominates. The deeper lesson is not to abandon discipline, but to question formulas that ignore context. Personal finance is not static. It is a reflection of the economy that surrounds it. In closing, the most realistic perspective is neither alarmist nor complacent. The United States is not facing collapse, but it is facing recalibration. In such moments, rules must bend, expectations must adjust, and resilience must replace certainty. The 50/30/20 rule once offered clarity. Today, clarity comes from understanding limits and planning honestly within them. As this story ends, the question is no longer whether the 50/30/20 rule is right or wrong. The question is how closely it resembles your own life. Does your budget still leave room for saving without sacrifice, or has survival quietly replaced balance? We invite you to reflect not just on percentages but on trade-offs you make every month. Share your experience, your adjustments, or your doubts. Because the future of personal finance will not be written by rules alone, it will be shaped by the realities people live through, one decision at a time.